All right. Thank you for joining us again for another quarterly update from the managers at MMP. You know, it's been a tough quarter, the first quarter. Want to start off with, getting everybody's opinion on the obvious topic. I think we have a ceasefire going on. I'm not 100% we have a ceasefire going on, but everything that's been going on geopolitically has had a lot of effect on the markets. Um, you know what? Who wants to jump in first and tell us how it's been affecting you guys?
Yeah, I'll jump in there. I think we've here at Main Management we've legged a little bit back into tech. We took some off the table back in December. You've seen those valuations come in. The big delta, that they've talked about with tech versus the rest of the market has pared down nicely, and so we saw a decent entry point. The big, one of the big drivers as well is simply that earnings haven't come in the same way price has, and that's been good. We've liked that. You want to see that solid, consistent earnings growth, and we haven't seen much deterioration there. So we put a little bit more back on the table on that tech exposure.
Yeah, I mean, I don't think there's any question that we saw a peak in the market, last fall, and we've sort of seen some fadings, especially in the what was the leadership prior the super mega cap growth uh, technology companies. So, from our standpoint, we were pretty well diversified going into the peak, and sort of our portfolios were lagging a bit because they were so narrowly led in the previous couple of years. So we've held up substantially better here since the peak down to the trough. We think things are more constructive now, but we've had more of a cash position in our portfolio, and we've always been a little bit more value oriented and a little bit more diversified across the capitalization ranges. So, the diversification has paid off for us here in this downlight.
Yeah, in the bond world, of course, we've seen rates go up, which isn't good for a bond fund. I'm typically, as I think you guys know, a little more defensively structured than most of the competition. So, on a relative basis, we've hung in pretty well during this. And frankly, it's provided some opportunities. We saw some forced selling there, oh gosh, 10 days ago, and we're able to pick up a couple of situations that, in my opinion, were very attractive and fit in perfectly with our value oriented approach. So we're sitting on some cash right now, mostly because we just had a very large inflow. But I view it as an opportunity to put some money to work. Have no idea how all of this mess is going to turn out, but I'm a skeptic on the ceasefire.
That's good. Now, I've heard a lot with everything that's been going on economically because the straits have been closed and everything. We're now hearing talks about inflation may bounce back up to around 4%. The Fed may basically stop tightening or may even have to raise rates at this point. What are some of your guys' opinions on that?
Well, let's get one thing clearer from our standpoint. Certainly, the activity in the Middle East has not been helpful, but we were facing inflationary pressures before any of this action started. The cost of rents have been still relatively high. Fuel prices, obviously, a supply shock in fuel prices doesn't help anyone. But we've been concerned about the economic growth and where inflation has been since before this happened. Certainly, this doesn't help. And in our opinion, it would be very difficult for the Fed. We've said this prior to the action in the Middle East, but we said prior to that it'd be very difficult for the Fed to consider cutting rates if we see persistent inflation and employment showing some weakness and economic growth where it's been. So you compound that with some further inflationary pressures, and I don't see the Fed. I don't see any path to easing anytime soon.
Yeah, I mean, you've seen that, reflected in the markets as well, where we went from, what was it, two or three cuts coming into the year to, now it's kind of hit or miss, but I think they're, pretty break even on nothing for the rest of the year, which is a pretty solid readjustment when, on 225 basis point cuts. You saw yields move up in response to this. I think we're definitely, on our recession dashboard, we just flipped inflation to kind of blue, which is neutral, to see where it goes. I think it's the risks are certainly to the upside rather than the downside. That core PCE number is lagged. It was February, it came out this morning, but it was still at 0.4% for the second month in a row, which is hotter than it's been running for a while. So to Rob's point, there's certainly inflationary pressures that have been there existing, and the fuel stuff really just kind of, for lack of a better term, adds some fuel to the fire. I think you looked at Delta coming out and they're saying they've already hiked bag prices to make up for the difference in fuel prices. They lost their first down quarter in a while. So I think you're seeing this in real time play out, and consumers they're probably gonna pull their horns in a little bit. I know the last two times I filled my car up, it's been 10-15 bucks more than it was for the last 6 months, and that doesn't feel great. And I think people are aware of that. So it'll be interesting to see how this kind of inflation uptick kind of maybe feeds into some consumer spending weakness. And you're already seeing kind of some talk about that. Although I guess if you look at Redbook's up just fine. So I don't know if they're getting data from some different stores or what, but it's interesting to see a little bit of a divergence in those spending metrics.
Yeah, I think there's potential for some consumer weakness. At the same time, I don't think we're going to move into a recession. We need to, see this be a little longer legged than it may be. Um, in my opinion, for me, frankly, it's kind of helpful if rates just stay here. A lot of my clients want yield, and this environment makes it a little easier. Now, importantly, and I've written papers on this in the past, uh, what the end client needs is real return, not you know, a bond yield that's pumped up just because now inflation's pumped up. So we'll have to see how real yields hold in here. But I think I'm in the same camp, guys, and thinking that we're likely to see some inflation. As I mentioned previous to the call, I'm on the road and spent some time along Interstate 40, which is one of the most heavily rail trafficked lines in the country. And we saw, I would call it kind of intermittent railroad traffic, not as high number of trains as I would normally have expected. So I don't have any real data to back that up, but I would suggest that, we may be seeing some slowdown in some things already.
That's great. Now, I do have one question that, I'm going to put out there more for Jerry, but I know I've got two economists on either side of him that would probably want to chime in on this as well. It's something that we're starting to hear a little bit more about. Um, the private credit crunch that's going on right now. I mean, I'm hearing talks that, some of the problems in private credit are actually worse than they were in 2008 at this point. It's a $5 trillion market that's looking at, 1.8 trillion in defaults at this point, and it's quietly getting more and more. And do you see this growing and having a greater effect on the fixed income market, or how do you see this trying to play out here?
Well, I think I've mentioned on prior calls that yield spreads are too tight for me to find them generally attractive, other than the spatial situation stuff that I'm generally involved with. I thought a year ago when we first started seeing cracks in the business development company market, BDCs, that was in the public side that I was seeing it. I thought that would be the canary in the coal mine with regards to credit risk in general, but we didn't really see spread widening in the high yield market as a result of that. We haven't seen a whole lot in this latest bout. Um, it seems like if there's problems there, they've got to creep into the public market. I'm not expert enough on their portfolios to be able to tell you what the depth of their problems are. I do know when the media gets a negative story going, they love to go with it. Personally, I think it's probably a little bit overblown. That doesn't mean it's not serious. Uh, and I really don't have sympathy, maybe diverging from your question a little bit, but I have no sympathy for somebody who bought something that was illiquid, expecting to get illiquidity premiums, knowing that they only were going to get 5% redemptions every quarter. I have no sympathy for them complaining about not being able to get out of their situation. That's a different element, but it's probably an important element going forward. This thing has a risk of becoming self-fulfilling. You may have seen there was an article on Bloomberg earlier today about the software exposure that this sector has and questions regarding refinancing. Again, if they're denied liquidity that they need, you may have some otherwise viable companies getting into trouble because they can't refinance. So there's more of this story to unfold, I think, over the next 12 months or so.
Okay.
Well, I think that's well said. And, as a mainstreamer, quote unquote, our worry is obviously contagion, right? We don't know, as Jerry said, we don't know exactly what's on some of these books, and we don't know what the derivative market is either. So it could be 5 trillion with 1.8 in default, which would be very large and market moving in and of itself. But if there are derivatives written on these things, if they've been collateralized in some way and resold, um, which most certainly they have, we just don't know to what extent. And that's where I think the media involvement becomes, is somewhat warranted, but becomes dangerous.
Yeah, I don't have a whole lot to add beyond what they've already said.
Perfect. Real quick, the last thing that I want to talk about is actually something that you guys talked about at the beginning, valuations. We've all talked about valuations and how they've been really high for a long time. With this pullback in all of March that we've now seen because of geopolitical is starting to turn around, are valuations more attractive now, or are they still too high? Do we still have further to go to make these valuations more attractive?
I think you've seen a pretty good pullback in some of the higher flying areas. So I don't know that we have a whole much of a catalyst for valuations to come down materially from where they were or where they are now. I think earnings are holding up pretty well. Maybe if you got some earnings deterioration, then that E might decline and the P goes back up. But I think that would make valuations higher than they are now, and I think we're working with what we got, for lack of a better term. It's kind of you're seeing some opportunities in places that we've put some money back to work, like in tech, but I think other areas, it's kind of steady as she goes.
If you tell me what the future earnings are going to be, I can tell you whether valuations are fair right here or not. I mean, that's basically where we're at. And it is sector dependent somewhat as well. I think there is some variance among the sectors, which does bode well for the type of management that at least Maine and ourselves do. So
Yeah.
Yeah, I can't speak to the stock market. I'll let the other guys, be the experts on that. But I still don't feel like credit risk bonds are especially attractive. If we are headed to some slowdown, I guarantee you they're not attractive. Uh, That said, I continue to find special situations that I like where I can pick up decent yield for the credit risk that I think I'm taking, and be opportunistic in the things that I find. So for me, it's not a whole lot different. I'm waiting to see if we get that crack in high yield and investment grade spreads. We haven't had enough yet.
And it's worth noting that your portfolios have held up well in this market because of the because of your approach. So thank you for your contribution to the team.
You guys are all a contribution to the team, and I really appreciate you guys doing this with us each month, each quarter. I thank you again. Go on, enjoy the Masters as it's just starting out as we're taping this. Other than that, have a great quarter and reach out to us if you have any questions. Thanks again for taking some time.
See you guys.
Thanks all.